Well, I need you to hear me very carefully. What I'm about to show you has never happened before in the entire history of cryptocurrency markets. Not in 2013, not in 2017, not in 2021, never. And if you don't pay attention to what's happening right now, in the next 6 to 12 months, you're going to watch other people make generational wealth while you're sitting there wondering what the hell just happened. Here's the situation. The S&P 500 just broke through 7,000 points for the first time in human history. January 28th, 2026, 702.28, all-time high. Wall Street popping champagne record after record after record. Meanwhile, at the exact same time, Bitcoin collapsed 40% from its peak from $126,000 in October down to $75,600. $2 billion in liquidations. Absolute carnage. People getting completely destroyed. Now, here's the part where your brain should explode. For the past 5 years, these two assets moved together like clockwork. When the S&P went up, Bitcoin went up. When the S&P crashed, Bitcoin crashed harder. The correlation was so tight that professional traders literally used S&P futures to predict Bitcoin's next move. That was the game. That was the rule everybody played by until January 2026, when everything just broke. The correlation shattered. Stocks ripping to all-time highs. Bitcoin face planting into the abyss, and almost nobody in mainstream financial media is talking about it. They're either ignoring it or they don't understand what it means. So, here's what we're doing today. I'm going to show you the actual data, not opinions, not bare propaganda, real numbers, historical patterns that have played out multiple times before, what institutions are actually doing with their money versus what they're saying on television. And by the end of this analysis, you will understand exactly what's happening, why it matters, and what the 3 possible outcomes are from here. But before we start, I need 3 things from you right now. First, smash that like button. Seriously, destroy it. If this video doesn't get at least 5,000 likes, I'm not making the follow-up videos. And trust me, you're going to want those follow-up videos. Second, subscribe to this channel immediately and hit that notification bell because this divergence is going to resolve violently in the next few months, and you need to be here when it happens. Third, drop a comment right now with just one word. Bull if you think Bitcoin is about to explode higher from current levels. Bear if you think we're heading to 50,000 or lower. I want to see where the crowd's conviction is before I show you what the data actually says. Do it now. Bull or bear comment section. Let's go. All right, let's get into what actually happened here because the story is fascinating. From 2015 through 2019, Bitcoin basically didn't care about traditional markets. Stocks would go up, Bitcoin would go down, stocks would crash, Bitcoin would moon. There was essentially zero correlation. Bitcoin was doing its own thing, living its own life. That's what made it attractive to portfolio managers as a diversification tool. You could own Bitcoin and it wouldn't blow up just because the stock market had a bad day. Then COVID hit in 2020 and everything changed. Suddenly, Bitcoin started responding to the same macro factors as stocks. Federal Reserve policy announcements, interest rate decisions, global liquidity conditions, risk appetite sentiment. From 2020 through 2025, Bitcoin and the S&P 500 developed this increasingly tight correlation. By September 2025, Bitcoin's correlation with the Nasdaq hit 92%. 92. That's basically the same asset, just different wrappers, different tickers, same trade. Let me show you how this played out in real time. March 2020, COVID crash. Everything falls apart. The S&P 500 plunges 34% in a matter of weeks. Bitcoin drops 50%. Both assets getting liquidated together. Everyone rushing to cash. Perfect. Correlation. Then the Fed announces infinite QE. Stimulus checks hit bank accounts. Both markets reverse hard. S&P recovers all losses by August. Bitcoin goes from $5,000 to $60,000 by April 2021, moving in lockstep. 2022 bear market year. The Fed starts aggressively hiking rates to fight inflation. The S&P 500 falls 20% from peak to trough. Bitcoin gets absolutely demolished. 75% drawdown from 69,000 all the way down to 15,500. Same direction as stocks, just with way more leverage and volatility. But the correlation held firm. You could predict Bitcoin by watching the S&P 2023 and 2024 recovery bull market. Fed signals they're done hiking. Rate cut expectations build. The S&P gains 25%. Bitcoin explodes from 15,000 to 70,000, eventually hitting 126,000 by October 2025. Correlation still completely intact. Traders literally watching S&P futures at night to position their Bitcoin trades for the next morning. That's how synchronized these markets became. But then January through February 2026 hit, and everything broke. The S&P 500 is up approximately 1.4% year-to-date. As of February 1st, it literally just touched 7,000 points for the first time ever. New all-time highs. The Russell 2000 Small Cap Index is up approximately 7.9% year-to-date. The Nasdaq Composite up 3.8%. Traditional markets in full bull mode. Risk on everywhere. Institutions piling into equities. And Bitcoin. Bitcoin dropped from approximately $90,000 in late January to $75,644 by the first weekend of February. That's 15 to 20% down year-to-date. But more importantly, it's down nearly 40% from the October 2025 peak of 126,000. While stocks are making new highs, Bitcoin is testing 10-month lows. The correlation didn't just weaken, it inverted, shattered, completely broke. Pull up a chart right now if you're watching this on a computer. Look at S&P 500 and Bitcoin overlaid from 2020 through December 2025. They move together. Same general direction, ups and downs, synchronized. Now look at January through February 2026. The lines diverge like they're running away from each other. S&P straight up, Bitcoin straight down. Not for a day, not for a week, for 2 straight months of sustained violent divergence. This has never happened at this scale since these assets started trading with high correlation in 2020. Never. And when something unprecedented happens in financial markets, you've got exactly 2 possibilities. Either something fundamental has permanently changed about how these assets relate to each other, or we're witnessing one of the most explosive setups of the decade. Before we figure out which one it is, make sure you're subscribed because when this resolves, fortunes are going to be made and lost. Now, let's examine the 3 theories trying to explain what the hell is going on. Part 2. The 3 competing theories. There are 3 main theories floating around right now trying to explain this divergence. Let's break them down one by one. Theory number 1. Bitcoin has finally matured and permanently decoupled. The digital gold finally arrived theory. This theory says Bitcoin has evolved. It's no longer just a leveraged bet on tech stocks and liquidity. It's become its own asset class with its own fundamentals. The evidence spot Bitcoin ETFs holding tens of billions. Countries adding Bitcoin to reserves. Major corporations like MicroStrategy never selling. Regulatory clarity improving. Bitcoin is growing up. Sounds great, right? Except this theory has one absolutely massive problem that nobody wants to talk about. Gold also crashed. On January 29th, gold hit an all-time high of $5,595 per ounce. Then it collapsed 15% in just 2 days down to around 4,700. If Bitcoin is truly digital gold now, why didn't it rally with gold when gold was making all-time highs? And why did Bitcoin fall even harder when gold crashed? Bitcoin is not acting like gold. It's not acting like stocks. It's not acting like anything we've seen before. Theory 1 doesn't explain what we're seeing. Theory number 2, the Kevin Warsh shock. This one's all about the federal. On January 30th, 2026, President Trump officially nominated Kevin Warsh to be the next Federal Reserve Chairman. Warsh is a former Fed governor who served from 2006 to 2011. He's got a Wall Street background from Morgan Stanley. And here's the key part. He's known as a serious hawk on monetary policy. He voted against QE2 back in 2010. He spent years publicly criticizing the Fed's bloated balance sheet. He wants a strong dollar, tight money, and real discipline. The market's reaction was immediate and brutal. The dollar index surged over 1%. Treasury yields spiked across the curve. And Bitcoin crashed 6% within hours from around 89,000 down to 81,000. Gold got destroyed, dropping 10% in a single day on January 30th. The worst gold crash since 1980. The theory is simple. Markets are pricing in a more hawkish Fed under war. Tighter policy, less liquidity, stronger dollar. That's poison for non-yielding alternative assets like Bitcoin and gold, but positive for dollar-denominated assets like use and stocks. Okay, but here's where this theory falls apart. If Warsh is hawkish and monetary policy is tightening, why the hell are stocks at all-time highs? Historically, when the Fed tightens policy, stocks eventually get crushed. Maybe with a lag, but they go down. Yet here we are with the S&P at 7,000. Russell 2000 ripping faces off. Small caps leading the market. How do you explain that? Something doesn't add up here, unless we're missing something bigger. Which brings us to theory number 3. This is the setup, the calm before the storm, the divergence before the explosion. This is the most controversial theory, but it's backed by actual historical patterns that have played out before. This theory says Bitcoin frequently diverges from traditional markets right before massive bull runs. The divergence shakes out weak hands, creates maximum pessimism, lets smart money accumulate at lower prices quietly. Then boom, face melting rally that nobody sees coming. Let me show you the pattern. September 2020, the S&P 500 had fully recovered to new all-time highs after the COVID crash. The Fed was printing unlimited money, QE infinity. Yet, Bitcoin was still stuck 30% below its February 2020 high, trading around $10,500. Divergence. Everyone said Bitcoin missed the rally, that it was over. 3 months later in December, Bitcoin exploded, went from 10,000 to 69,000 over the next 16 months. Anyone who bought during that September divergence made nearly 7 times their money. July 2017, the S&P 500 was steadily climbing all year, setting new records month after month. Meanwhile, Bitcoin spent May, June, and July completely sideways at around $2,500. 3 months of boring, dead sideways price action while stocks kept making highs. Divergence. Retail investors lost interest, got bored, sold. Then in August, Bitcoin started moving. By December, it hit 20,000. An 800% rally in 5 months. The pattern seems clear. Bitcoin lags behind stocks. Divergence develops. Retail gives up and sells. Smart money accumulates quietly. Then the explosion happens and catches everyone off guard. But here's what's critically different this time. In those previous examples, stocks were going up and Bitcoin was just going sideways, consolidating, not making new highs, but not crashing either. This time, stocks are going up and Bitcoin is actively falling. That's a more severe, more violent form of divergence. Pause for a second. Think about what you just heard. Drop a comment right now. Bull or bear, are you seeing this pattern? Do you think it's about to repeat? Or do you think something fundamental has broken? I genuinely want to know what you think. Comment section. One word, bull or bear. Now, let's look at the indicator that 99% of people are completely ignoring. On February 2nd, 2026, the Institute for Supply Management released the U.S. manufacturing PMI data for January. The number came in at 52.6. If you're not a markets nerd, you probably scrolled right past that headline. It got almost zero attention in mainstream financial media. But if you understand economic cycles and leading indicators, this number potentially changes everything. The PMI, or Purchasing Managers Index, measures manufacturing sector health. Above 50 means expansion. Below 50 means contraction. Simple. The U.S. manufacturing sector had been contracting for 12 straight months. Every single month from January 2025 through December 2025, the PMI was below 50. Manufacturing was shrinking. Then boom, January 2026, PMI crosses above 50 for the first time in a year. It's 52.6. That's the highest reading since August 2022. Why does this potentially matter for Bitcoin? Let me show you something interesting. And I need to be very clear up front. This is not a scientifically proven causal relationship. This is pattern recognition from historical data. But the pattern is striking enough that you need to pay attention. 2012 PMI crosses above 50 in August after months of contraction. Bitcoin is trading at $12. 12 months later, Bitcoin is at $1,000. That's over 8,000% if you bought when the PMI crossed 50. 2016 PMI crosses 50 in September after a prolonged manufacturing recession. Bitcoin is around $600. 18 months later, Bitcoin hits 20,000. 3,300% return 2020. PMI crosses 50 in July as the economy starts recovering from COVID lockdowns. Bitcoin is at 10,000. 12 months later, Bitcoin touches 69,000, almost 600%. Now, I know what you're thinking. Correlation doesn't equal causation. There were other factors in all 3 of those periods. The Fed was easing. Global liquidity was expanding. Risk appetite was increasing. Crypto was going mainstream. But 3 times out of 3 isn't coincidence. That's a pattern. The PMI crossing 50 signals economic expansion is beginning. And when economic expansion starts, risk assets tend to rally. Bitcoin, being one of the highest beta risk assets in existence, tends to go absolutely parabolic when that expansion takes hold. Here's the detail everyone misses. In all 3 previous times when the PMI crossed 50 and Bitcoin subsequently exploded, Bitcoin was in a period of weakness or consolidation when the PMI actually crossed. It was never making new highs. It was always down, sideways, or recovering from a crash. Exactly like right now, 2012, Bitcoin had crashed from $32 to $2 earlier that year. When PMI crossed 50 and Bitcoin was at $12, still way down from the peak. Retail had given up completely. Then the rally started. 2016, Bitcoin spent the first half of the year stuck between $400 and $600. When PMI crossed 50 in September, sentiment was dead. Nobody cared. 6 months later, face melting rally. 2020, Bitcoin crashed from 10,000 to 3,800 during COVID panic. Recovered back to 10,000 by July when PMI crossed 50. Sentiment was still fragile. Everyone expected another crash. Instead, straight to 69,000. The setup today, Bitcoin crashed from 126,000 to 75,000. 40% drawdown. Massive capitulation. Retail is terrified. Bitcoin ETFs saw 1.6 billion in outflows during January. Media running headlines about the death of digital gold. Pessimism everywhere. And the PMI just crossed 50. If the pattern holds, Bitcoin should start a major move higher sometime in the next 6 to 12 months. If you're still watching, you're already ahead of 99% of investors who will completely miss this. Make absolutely sure you're subscribed. Hit that bell because I'm going to be tracking this setup closely over the next few months. And comment below, bull or bear, what's your conviction level after seeing this pattern? Now, let's talk about what institutions are actually doing behind the scenes. Let's talk about the gap between what institutions say publicly and what they are actually doing with their money. Because that gap is enormous right now. In January 2026, Bitcoin ETFs saw massive net outflows, approximately 1.6 billion. That's the third worst month since these products launched in January 2024. The selling was everywhere. Fidelity's FBTC lost 247 million. Grayscale's GBTC shed 83 million. Bitwise, ARK, VNC, all bleeding assets. January 29th was the peak of the carnage. Bitcoin ETFs lost 817.9 million in a single day. The largest one-day outflow since November 2025 that triggered a liquidation cascade. Over 1.75 billion in leverage long positions got wiped out in 24 hours. January 30th, nearly $1 billion in total outflows across Bitcoin and Ethereum ETFs combined. This was real capitulation, panic selling, institutions and retail both running for the exits. But here's where it gets interesting. Early January was different. On January 3rd, BlackRock's IBIT had inflows of 287 million in a single day. That was the largest single-day inflow for IBIT since October 8th. So before the late January massacre, something smart money was accumulating. BlackRock, the world's largest asset manager, was buying while prices were in the low 90s. What does this tell us? Institutional positioning isn't uniform. Some institutions panic sold during the crash. Others strategically accumulated before the worst selling hit. This is classic market psychology. Smart money buys when retail is complacent, watches retail panic and capitulate, then positions for the next leg up after weak hands are shaken out. The picture is nuanced. Yes, there was massive fear and capitulation in late January. The ETF outflow data proves it. But there was also accumulation earlier in the month from sophisticated players who might have viewed 90,000 as an attractive entry. The question is which group ends up being right. The panicked sellers at 75,000 or the strategic buyers at 90,000. History suggests that when PMI crosses 50, when divergences hit extremes, and when retail capitulates completely, the patient accumulators tend to win over 6 to 12-month time frames. But history doesn't always repeat. Sometimes it rhymes, and sometimes the pattern breaks entirely and something new happens. Before we go further, have you subscribed yet? Do it now and drop that comment. Bull or bear? I'm reading every single one. Now, let's talk about the fundamental question nobody's asking. Here's what almost nobody in crypto is actually discussing. What if the correlation between Bitcoin and the S&P 500 was never really about fundamentals? What if it was always just about liquidity? Think about it. From 2020 through 2025, global central banks engaged in the most extreme monetary expansion in modern history. The Fed's balance sheet exploded. ECB printing, Bank of Japan printing, People's Bank of China expanding, global M2 money supply going absolutely vertical. During that entire period, Bitcoin's correlation with stocks was really just correlation with one thing: liquidity. When central banks printed money, both stocks and Bitcoin went up. When they tried to tighten even a little bit, both went down. The correlation wasn't about Bitcoin becoming like stocks. It was both assets responding to the same underlying factor: the amount of money sloshing around the global financial system. Now we're potentially entering a different regime. Kevin Walsh, if he gets confirmed, represents discipline. Smaller balance sheets, less accommodation, tighter policy, stronger dollar. But here's the critical insight that changes everything. Tighter Fed policy doesn't automatically mean tighter global liquidity. China has been easing aggressively. Multiple rate cuts, more stimulus, no signs of stopping. Japan still running negative rates in QE. The ECB still relatively accommodative compared to what Wirsh might do. So you could have this scenario. The US Fed tightens under Wirsh that supports the dollar, makes US stocks attractive, brings capital into American equities. Meanwhile, other major central banks keep the money flowing. That liquidity has to go somewhere. It can't all go into US stocks forever. Eventually, it finds alternative assets like Bitcoin. This would explain the divergence perfectly. US stocks benefit from a stronger dollar, solid corporate earnings driven by AI, spending, and stable domestic policy. Bitcoin initially suffers from Fed tightening expectations and dollar strength, but then benefits from continued easing globally. The divergence is temporary, just a lag effect. Eventually, capital flows adjust, and Bitcoin catches up violently. This theory suggests both assets go higher from here, just on different timelines, stocks first, Bitcoin later. But it requires patience. It requires surviving the period when everyone thinks Bitcoin is dead. It requires conviction when the price action is absolutely brutal. So, let me ask you directly after everything you've seen so far. Where's your conviction? Comment bull if you're buying or holding here. Comment bear if you're selling or waiting for much lower prices. And if you somehow still haven't subscribed, what are you doing? This channel is tracking this divergence every step of the way. Subscribe now. Let's keep going. Let me synthesize everything into a clear framework for what happens next. We have 4 major factors all converging at the same time right now. Factor 1, extreme divergence between Bitcoin and the S&P 500 at a scale we've never seen since these assets started correlating in 2020. Divergences always resolve eventually. The only question is how. Does Bitcoin crash lower? Do stocks crash down? Or does Bitcoin explode up? Factor 2, PMI crossing above 50 for the first time in 12 months. While not scientifically proven as a Bitcoin predictor, the observational pattern across 3 prior cycles is compelling. Time lag from PMI cross to Bitcoin rally has been 2 to 6 months historically. We're currently in month 1. Factor 3, massive institutional capitulation, 1.6 billion in ETF outflows. Heaviest single-day selling at over 800 million. When institutions panic sell, that's historically marked bottoms, not tops. Factor 4, Kevin Walsh and hawkish Fed expectations creates short-term headwinds from dollar strength and reduced liquidity expectations, but could set up the perfect contrarian trade if global liquidity continues expanding despite US tightening. How does this resolve? 3 scenarios. Scenario 1, more downside first. Bitcoin falls to 65,000 or lower. Full 50% retracement from the peak, maximum despair, flush out every last leverage long. Then the real bottom forms. PMI signal suggests rally begins April through July. In this scenario aligns with Bitcoin's 4-year cycle patterns. Scenario 2, immediate reversal from here. Bitcoin already bottomed at 75,000. Rally starts in the next 4 to 8 weeks, selling exhaustion complete. PMI cross acts as the catalyst. Sentiment flips from extreme fear to cautious optimism. This would be the most explosive scenario. Short covering, FOMO, feedback loops. Bitcoin potentially back to 100,000 by summer. Scenario 3, prolonged chop. Bitcoin ranges between 70 and 90,000 for 3 to 6 months. No dramatic crash, no explosive rally, just frustrating sideways action that exhausts everyone. Then in second half of 2026, as PMI signal gets confirmed and Fed expectations stabilize, sustained rally begins into 2027. Maximum pain scenario. I can't tell you with certainty which one plays out. Nobody can. But I can tell you what the patterns suggest. Extreme divergence plus PMI cross plus institutional capitulation plus retail pessimism has historically preceded major rallies within 6 to 12 months. Not certainty, just probability. One more time, have you liked this video yet? Do it now. Are you subscribed? Hit that button and comment. Bull or bear? Let's see where everyone stands. Now let me wrap this up. If you made it this far, you understand something 99% of people will completely miss. Markets move before the narrative catches up. By the time everyone agrees Bitcoin is going higher, most of the move is already over. The question isn't whether you'll see the rally when it's obvious. Everyone will see Bitcoin at 150,000. The question is whether you have the conviction to position now when it looks broken, and the narrative says it's going to zero. This is how generational wealth gets made in markets, not when things feel safe, when they feel terrifying. Right now, the narrative says Bitcoin is dead. Digital gold failed. Correlation broke forever. It's going to 50,000. But some of the data quietly suggests something different. PMI crossed 50 divergence at historic extremes. Institutions just capitulated historical patterns pointing to potential setup. Which do you believe? Narrative or data? I'm not telling you to buy. I'm not telling you to sell. I'm showing you the patterns and letting you decide. But decide based on information, based on probabilities, based on proper risk management. If you think Bitcoin follows historical patterns, current levels could be a high probability zone for a 6 to 12-month time horizon. If you think something fundamental broke, cash or traditional assets might make more sense. Both views are valid. The key is having a plan and sticking to it. Last call. 3 things. 1. Like this video. Crush that button. 2. Subscribe and hit notifications because I'm tracking this closely with updates coming. 3. Comment right now. Bull or bear? One word. That's it. Let's see what the crowd thinks. The divergence will resolve. That's certain. The only question is how. Will Bitcoin rally to meet stocks? Will stocks crash to meet Bitcoin? Or something in between? Based on the data I've shown you, I lean toward Bitcoin rallying over the next 6 to 12 months. But I could be completely wrong. The market doesn't care what I think or what you think. It does what it does. Our job is understanding probabilities, managing risk, and staying flexible. The correlation from 2020 through 2025 just broke. The PMI just crossed 50. Institutions just capitulated with 1.6 billion in outflows. And the S&P just hit 7,000 while Bitcoin dropped 40%. This has never happened in this exact combination. When something unprecedented happens, it's either the end of an era or the setup for something massive. Historical patterns suggest setup. Sentiment suggests end. The next 6 months prove which is right. Position smart. Manage risk. Stay informed by subscribing. And remember, the biggest opportunities always look like disasters before they look like opportunities. That's what makes them opportunities instead of obvious trades everyone sees. Now drop that comment. Bull or bear, let's go. See you in the next video.